Welcome back, students. So today we are going to discuss another case study on leasehold property with application of additional concepts on Rent Control Act and Sinking Fund. So this is another level of difficulty in the case study, and we will apply multiple new concepts to make it more harder and to make it more understandable, so that students can get a feel of real exam situation. So as always said, if you have not you have not cleared all your theory concepts on real estate valuation and income approach to valuation till now, so please stop this video right now and clear your concept first. Do not jump to case study straightforward. So let us proceed with the case study without wasting time. So this is the whole syllabus. We have already covered this entire syllabus on income approach to valuation in both Hindi and English on our channel. So let us first understand what is given in the case study. In 1965, Mr. X leased out land at measuring 2,500 square meter for a period of 70 years with annual lease rent of rupees 3,000. So that means X had given a land in 1965 and the lease period is 70 years and annual lease rent is 3,000 ground rent. Lessee means tenant of the land constructed a residential building and rented out this building to tenants against annual rent of 50,000 rupees. So the lessee took this land from Mr. X and constructed a building on that and started getting gross annual rent of 50,000 rupees from the tenants. As per lease agreement terms, on maturity of lease, the building will vest with lessor free of cost. So this is a financial covenant which we have to discount to calculate lessor and lessee interest. Rent Control Act is applicable to the tenants in the building but not to lessee. So there is application of Rent Control Act and assume yield 8% and recoupment rate 4%. Since the recoupment rate is given, so we have to calculate sinking fund factor as well. So now, just to keep it simple, let us calculate lessor interest in 2010 and lessee interest in 2010. As always, I say first note down data given in the question and then note down questions to be asked. So in this land area is this total lease period is 70 years with effect from 1965. So that means remaining lease period is 70 years minus 2010 minus 1965. So it's 25 years of remaining as of 2010. Annual ground rent is 3,000, which lessee will pay to Mr. X, and gross annual house rent, which sub-lessee or tenants will pay to lessee, 50,000 rupees. This is the financial covenant that on maturity building will pass on to lessor without any cost. And the Rent Control Act is applicable on tenant in the building but not on lessee. And yield and recoupment rate is key. So before you proceed to next slide, try to solve this question case study with the help of calculator or maybe Excel sheet, and then move to next slide to cross check your answer. So basically lessor has two type of interest in this property. First of all, right to receive ground rent of 3,000 rupees annually for next 25 years. Mr. X, right? Lessor is Mr. X, and he will receive perpetual rent from the property after 25 years because there is a Rent Control Act. So house tenants cannot be evicted even after expiry of lease period, so they will stay. However, they will start paying rent instead of lessee to lessor, Mr. X. So for first 25 years, lessee will take rent from tenants, and after 25 years, lessor will start taking rent from tenants. So lessee will have interest in terms of house rent of 50,000 rupees from the tenants for next 25 years. That's the only interest lessee has, and these two type of interest lessor has. Now we have to calculate each of these interests separately, and then we have to calculate the answer. So first of all, we know the formula of year purchase because it is 8% yield at 25 years piece of period. So year purchase or yield purchase for 25 years, by putting this into formula, we have already calculated this formula, derived this formula in previous sessions. So don't get confused. That's why I always tell, go through, clear your concept first and then jump to case studies. So this is the 10.67 is a yield purchase. Now, what is the value of ground rent? So for next 25 years, he will get 3,000 rupees, and year purchase for 25 years is 10.67. So if we multiply annual ground rent multiply by year purchase of 10.67, the present value or capitalized value of ground rent of 3,000 rupees for next 25 years is 32,010 rupees. This is first type of interest which lessor has or Mr. X has. So now perpetual rent. So till 25 years, lessee will get the rent, but after 25 years, lessor will get perpetual rent. And we know formula for perpetual rent, capitalized to calculate capitalized value of perpetual rent, is annual house rent divided by yield. So here in this case, after 25 years, the property will be vested with Mr. X. So he will start getting 50,000 rupees every year perpetually. So 50,000 is on top and 8% is yield, which is given in the question. So capitalized value of the rent, perpetual rent, which lessor will get, and capitalized as of date of 2035, not 2010. So this is the value of future perpetual rent as of 2035. Now we have to further discount it to 2010 by dividing it with 1 plus IC, which is yield raised to 25. So present value of this rent is equal to 91,261. So if we add capitalized value of ground rent as of 2010 and capitalized value of perpetual house rent as of 2010, the net total interest of lessor in the property is 1,23,271. Now let us calculate lessee's interest. So lessee will get profit rent of 47,000. How we have calculated it? Total house rent is 50,000, but he has to pay 3,000 to the lessor, Mr. X. So net he will get 47,000 in his pocket for next 25 years. So now we have to calculate SFF or sinking fund factor, which is this formula. Already discussed many times in past, and we can calculate SFF with the help of Excel sheet as well, that we will calculate in next slide. So SFF factor is 0.0240. So dual rate of yield purchase dual rate is nothing but 1 divided by yield plus SFF, which is like this 9.615. So if we multiply profit rent with yield purchase dual rate, the value of lessee's interest is 4,51,923. So the surprising factor is that lessor, in spite of being owner of the property, has lesser interest, low interest, right? However, lessee has higher interest in the property. So now let us solve this question with the help of an Excel sheet. Okay, so to keep this to shorten our time, we have already entered data given in the question on this side. I always said my students first enter all data given in the question, and then on right side enter data like questions asked. Correct? This is the first and simplified method. So now let us calculate this information without using functions, right? So we know formula for year purchase. What is that? So if you see, this is the formula for year purchase. So let us calculate it with the help of formula, equal to 1 minus 1 divided by 1 plus r raised to power n. Correct. Let us compare it with, just double check our formula. So divided by IC. So here 1 divided by 1 plus PV divided by divided by IC. Okay, so let's double check. I think 1 3 1 10.67. So this value has been matched, 10.67. Now present value of ground rent is equal to yield purchase minus multiply by 3000 rupees. So this is matched, 32,010, like because of rounding of figure. And then capitalized value of rent as of 2035. So this 50,000 divided by actual rent yield 6,025, and then present value of above capitalized value is equal to this divided by 1 plus yield raised to power 25. So this is the value. So that means lesser interest is this plus this. So this is the answer 1, right? Now for lessee interest, profit rent is 50,000 minus ground rent, which is 3,000. Now SFF, we know the formula for SFF, which is IS divided by bracket, double bracket, 1 plus IS minus 1, raised to power 25 and minus 1, bracket close. So this is the SFF. So dual rate, year purchase dual rate, 1 divided by bracket open yield plus SFF. So this is the yield purchase, and if you multiply ground rent with this yield purchase dual rate, so this is the value of lessee's interest in property. So let us calculate this SFF with the help of function as well. If you're lucky and your functions are enabled, we can calculate SFF without using formula, using function of PMT. So PMT rate is recoupment rate, then NPAR is period, years, number of years, present value is 0, and then future value is 1, and this end of the period, which is 0. So you see, so this is matching 0.024. So here sinking factor and this sinking factor both are matching. So thank you very much once again for watching today's video. I think you might have cleared this case study with the help of Excel sheet and without help of Excel sheet. So if you are going to join a IBBI Cracker Fast Track 31 days crash course, you can ask your further questions if you have any doubt on that. Otherwise, you can again go through this video to clear your concepts. If you have not subscribed to the channel, please subscribe it and click on bell icon so that you will be notified about next upcoming videos. And it's a request, please like this video and do comment if you have anything in your mind, so that we feel motivated to post more such videos in future. Thank you very much and see you in next video.